Do you invest in the Indian stocks or the Indian equity? Or are you planning to do so in the coming months? Even if you're investing in the mutual funds, there's something that the government is looking to do that could impact your returns. The government is planning to change the way the long-term capital gain tax is calculated. So what does this mean for investors? I'm Sachin Dave, Senior Editor with Economic Times, and we'll go through what could happen and how this could impact your returns from the Indian equities. The government has begun work on bringing parity of tax rates, that is long-term capital gain tax applicable on debt, listed and unlisted equities. As of today, there are separate tax rates when it comes to long-term capital gain tax from listed equity, unlisted equity and debt. Not just that, there is also the way the long-term capital gain tax is calculated. For instance, for listed equity, you have to hold the equities or shares for about a year and it is considered long-term. For unlisted shares, the period is 24 months. The government could also bring parity between the holding period of these different asset class. Our sources tell us that the government wants to change this so that to bring in simplicity for investors, whether he is an Indian investor or a foreign investor. So if there is an NRI who invested in say in unlisted equities, then the tax rate applicable is about 10%. On the other hand, the returns for Indian investor on similar unlisted shares is 20%. Many Indian investors in the past have approached government and asked for parity, at least on this front. But what could happen is very unclear. There are two major things that many fear could happen. On one hand, there are skeptics who feel that the government could actually bring in the listed tax rate, the long-term capital gain tax on listed equities to 20%. On the other hand, there are also many analysts who feel that the tax rate for unlisted equities could go down from 20% to 10%. As of now, as we understand, the government officials are merely conducting analysis on the impact on the revenue that could have. That is, the government's tax collection could be impacted if these tax rates are tweaked. As many of you may remember, till 2018, there was no long-term capital gain tax. That is, if you hold the equities or listed shares for about a year, then you need not pay any tax on that. In 2018, the government came out with 10% tax on long-term capital gains. That is, even if you sell the shares after a year, that is listed shares after a year, then you have to cough up at least 10% following an indexation, that is, deducting the cost of acquisition. At that time, this was many feared that this could lead to several investors sitting back or opting out of the stock market. However, the reverse has happened. More and more investors have hopped onto the share market or the listed equities in the past 2 to 3 years. As of today, anywhere around 6,000 crore are being pumped in the Indian equities by mutual funds every month, which means that not only are more people wanting to invest in the listed equities, many investors feel that this could be one of the best asset class for the long term. That is, if you hold these equities for 10 to 15 years, then probably it could give better returns compared to say real estate or gold or definitely fixed deposits. So why is the government looking to tweak long-term capital gain tax? One of the reasons that many say is that there is a thinking in this government that returns, at least the long-term capital gain tax on equities, is nothing but passive income. That is, only the rich people tend to earn more and more as time goes without doing anything specific. That is, they are not manufacturing anything, they are not producing anything, and yet they get returns. This is what many tell us is one of the perception that many in the government have. Globally, you have seen that global governments are going after rich individuals, that is the high net worth individuals. They want to tax them more and they want that these individuals cough up more taxes on the returns from the shares, that is from the equities. this is not just in India, but globally, this has seen a trend. Whether India will follow this or not is something that we'll have to see. On the other hand, there are several people or several analysts who feel that this might not be the right time to increase long-term capital gain tax on listed equities. That is, they say that if, say for instance, you increase the long-term capital gain tax from 10% to 20%, then what would happen to the LIC IPO? The government wants to raise thousands of crores through LIC IPO. Now that might just be impacted. Not just that, at a time there is a global turbulence happening because of the Russian crisis and several other situations in the US, the inflation is high, and stock market might be one of the few areas that might be doing well for the Indian government. Now, should they rock the apple cart at this point in time, or whether India can afford to increase the long-term capital gain tax and still continue to see growth spurt in the Indian stock markets or the Indian shares? This is something that only time will tell. However, what we understand is that the government, as of now, may not have taken any specific decisions. The government is looking at several analyses by the government officials, and by the end of December, the government could come out with some sort of interaction or may interact with some of the analysts. While it might be too early as of now, because even if there's a change, it could happen only by next budget, that is by January, February next year. But whether Indian investors will take this kindly, or whether the Indian investors might just put a brake to their mutual funds or to buying more and more equities because of any change in long-term capital gain tax, only time will tell.